What is technical analysis? Technical analysis is using market data to identify trends in a particular stock or in the stock market as a whole. A technician uses charts and chart patterns to determine these trends. They may also use price indicators and volume. So here is a stock chart here, and the stock is FSLY, and we have indicators. Here's the RSI indicator, we have the MACD indicator, and we have moving averages over here. And we're going to speak about that further on later on in the course, how to use these indicators. And a technician will look at this chart and determine good places to buy and sell a particular security. So when you look at this chart here, even if you don't know anything about this company, you could say, wow, something's good going on here because it went from 45 to 105 very quickly. So without even knowing anything about this company, just looking at the chart can tell you a lot. So that's what a technician wants to do with technical analysis. They want to determine trends in stocks by looking at a chart. And a chart uses price and volume. Okay, so here's our price candles over here, and here's our volume down here. Volume tells you how many shares are traded in a day or a given period of time, and then price tells you the movement. Did the price go up that day or did it go down that day? And indicators will give you different information about a stock. So for instance, the RSI indicator will tell you if a stock is overbought or oversold, and the MACD indicator will let you know if a security is having a buildup of momentum. And moving averages help you to determine the trend. So we will discuss these further on later on in our course. So why would someone use technical analysis? They give you visual clues. Charts give you a clue to what is going on. Okay, and a picture is worth 1,000 words. And when you look at a chart, you can see very clearly what's going on. You see the psychology of all the traders behind a particular stock. And usually, not always, but usually when a stock looks a certain way, you can say, well, in the past, if a stock did this, it went up. So maybe this time it will happen as well. So it's not certain. There's no certainties in the stock market, but you can say through patterns of the past, typically when this happens, a stock will then go up. Okay, so charts help you to determine probabilities, not predictions, but they help you to determine probabilities of what may or may not happen in a particular stock. They also help you to manage your risk to reward ratio when you're trading. So just looking at this chart, I can see, wow, look at this. It seems to hug this 20-day moving average, this green line. Notice it comes down here, FSLY, and then it bounces. So that's something that's interesting. You say, oh, it bounced here, it bounced here. So sometimes what traders will do, they'll say, I'll wait for this to come down to this moving average, and I'll try to buy it off that point. Another indicator that traders will use will be the RSI. And we're going to talk about this further on in a later section. Sometimes when stocks are oversold on RSI, see how it's red here? Sometimes they bottom when that happens. So that's why traders look at charts, because they want to look at trends and they want to go for probabilities. Nothing is perfect. We never can make perfect predictions every time, but we go with probabilities. Charts give you a very good picture of what's going on here. Here, Tesla. Even if you don't know much about Tesla, even if you've never driven in their car before, you could say, wow, something's going on here. This went from 500 all the way to 1643 very quickly. So something's going on here. Even if you've never driven in a Tesla, even if you don't like the car, even if you don't like Elon Musk, just looking at the chart can give you a great picture of what's going on. Fundamental analysis is another way of evaluating potential investment opportunities in the stock market. However, fundamental analysts do not typically use charts. What they're going to do is they're going to focus on financial statements, PE ratio, sales, earnings per share, book value, cash flow, dividend yield. They also may conduct discounted cash flow analysis, which is you figure out how much a stock is worth and try to buy it at a discount. So some people combine both. They combine fundamentals and technicals. Somebody like Warren Buffett will not use charts. He doesn't believe in it. He just goes by the fundamentals. Now, I started as a fundamental analyst and I never made money. And then I started making money as a technician, and now I don't use any fundamentals. So I'm going to tell you some of the drawbacks of using fundamental analysis. If a fundamentalist was playing fantasy baseball, what they would do is they would look at a player's past statistics to evaluate how much he is worth. So they would say last year this person had so many doubles, so many triples, so many home runs, so many RBIs. And because they have these particular statistics, they would be worth this amount of money and they should be drafted in this particular round. Say, so if you've ever played fantasy baseball, you know what you do in fantasy baseball is you either draft a player with money or you draft them in a particular order. So you have to calculate, this person has this stats, they should be drafted first, or they have stats that are not as good, they should go in the fourth round. So a fundamentalist makes their decisions based on past statistics. In the stock market, that would be sales, earnings per share, dividends, things like that, okay? Now let's look at technicals. Technical analysis is not worried about past statistics like earnings per share or book value or any of those type of things. Instead, he wants to see what others are doing. So in our baseball analogy here, the technician in the baseball analogy, he wouldn't really care what the person's statistics were last year. They'd say the past is the past. What they would want to look at is, are other people interested in this player? What round is he being drafted in fantasy baseball leagues? So a fundamentalist is going to try to buy at a bargain, and a technician is looking to ride trends. So let's take this fantasy baseball analogy a little further. Playing fantasy baseball, the fundamentalist says, well, last year he had 30 home runs, he had this many RBIs. The technician would say, you know, this guy, I'm noticing a lot of people are drafting him earlier this year. Something's probably going on. I'm noticing that a lot of people are talking about this player. Maybe he's hitting more home runs. Maybe he's having a great spring training. Okay, so the technician is not really worried about what happened in the past. They're worried about the trends, and they want to see what's going on in terms of price and in terms of volume. The difficulty with fundamentals is it's based on past earnings and sales, and these may fall. So just as a baseball player, maybe last year he had 30 home runs. There's no guarantee he's going to hit 30 home runs this year. He could get older, he could get hurt, and now maybe he only hits 10 home runs. Same thing with a company. A company may have great earnings last year, but their earnings may go backwards this year. Maybe they're having a problem with leadership. Maybe there's a slowdown. Okay, so there's no guarantee that the future is going to look exactly like the past. Another thing is it is extremely difficult to determine a margin of safety price to buy a stock at. So what Warren Buffett does is he looks at a company and says, you know, this company is worth $100 a share. What I'm going to do is I'm going to buy it at $50 a share because I'm going to get a great discount. The problem is it's very difficult to do that. And I used to spend a lot of hours trying to figure out what a stock is worth. You really could drive yourself crazy. It is extremely, extremely difficult. That's called discounted cash flow analysis. And I used to create Excels, and I used to try to figure out what a company is worth, and it's very difficult. The other thing is the company may never fall to that price. So you could do all this analysis, and you could say, you know what, Apple is worth $100 a share. I'm going to wait for Apple to go to $100 a share, and then I'm going to put all my money into Apple because that's going to be a great deal. And meanwhile, Apple just keeps going up and up and up, and it's at 200, 300, 350, and it never drops to that $100 value. So that happened to me in the past. I did all this fundamental analysis. I said, I want to buy Apple. I think Apple's worth this amount of money, and it just never came down to that price. It's also very difficult to manage your risk when you're doing fundamental analysis because you never know if you're wrong. So for instance, let's say I say, you know, Apple is worth $500 a share, and it's currently trading at $350. I'm going to buy Apple at $350. Okay? Let's say Apple starts going backwards in price. How do I know I'm wrong? How do I know if I made a mistake? And sometimes people will do fundamental analysis and they'll say this stock is worth $100 a share and it's currently trading at $25 a share. This is a great bargain, and they'll load up, and before they know it, that stock is trading at $10 a share. And it's very difficult to determine when you made a mistake because your stock is going down, and sometimes what people will do is they'll buy more of it as it goes down, and then they get caught in a trap because the stock may never return to its old value. And we're going to talk about that more in the section on risk management. Also, just because a stock has great fundamentals, it doesn't mean it's going to go up. The only way you make money is if the stock goes up. So if a stock has a great PE ratio and it has accelerating earnings and it has sales growth, and everybody loves the company, but the price of the stock keeps going down, what's the point of buying it? I only make money if the price goes up. So shouldn't I just follow the price then? Because that's the only way I make money. Okay, so I make money when the price of the stock goes up. Nothing else helps me to make money. Price is the only thing that pays. So why don't I just focus on price? Here's a chart of Berkshire Hathaway. This is Warren Buffett's company here. And notice the QQQ has outperformed drastically since 2004. So the QQQ is the NASDAQ 100. And notice it has performed way better than Berkshire Hathaway during that period of time. So if you had bought and hold both of these, you would have made money with both. But notice the returns are much higher, almost 1,000% versus 284%. So you make much more money buying and holding the NASDAQ 100. So it's not that I'm trying to beat up on Warren Buffett. He's a billionaire. I'm not a billionaire. But what I'm saying is just because he does it doesn't mean it's the fastest way to make money or the easiest way to make money. Because you notice over the past 16 years, you could have made more money just buying and holding the NASDAQ 100. Would you rather listen to conference calls and analyze financial reports, or just look at the chart? Now, I used to do this when I first started. I used to listen to conference calls, and I used to go through analyst reports, and I tried to figure out all these things about a company. Well, this analyst says it's worth $350 a share, and maybe they're going to come up with this product. I used to drive myself crazy trying to analyze all this data. Then I realized I could just look at the chart and it could tell me everything that's going on here. Okay, so even without knowing much about Tesla here, you could say, you know what? I've never been in the car. I don't know much about Elon Musk. I don't know much about electric cars, but hey, you know what? Stock's going up, something good is happening. Okay, so just looking at the chart can tell you an entire story, and it could save you a lot of time and energy from having to analyze all these analyst reports. Many investors miss out on tremendous buying opportunities because they do not use charts. They do not follow trends. Instead, they try to interpret the news. Here's a chart of the NASDAQ 100 in 2020. Notice it went on a very strong uptrend from March 23rd into July 2020. During the same time, the world and the United States was suffering from the COVID-19 pandemic. The United States had an increase of cases of COVID-19. 143,000 people have already died from this virus, yet the stock market keeps going up. So sometimes there's a disconnect between the news and the stock market. If you try to figure out the news too much, you miss a lot of these opportunities. So a technician is not going to be worried about the news. They're going to just be worried about the chart. And they're going to say the chart is bullish, let me take a position. And they just ride the trend until it ends. They don't worry as much about the news and trying to figure it out. Because sometimes the stock market doesn't make sense. It doesn't make sense that the United States has an increase in COVID-19 cases and the stock market goes up. But it's not about making sense, it's about making money. So if you're an investor, you're trying to figure out all this new stuff and you're trying to do fundamental analysis. If you're a trader and you're a technician, you just go by the chart and you stick with the trend until it ends. A picture is worth 1,000 words. A stock chart can tell you much more about a company than you realize. On May 1st, 2020, Elon Musk tweeted Tesla's price was too high in his opinion. So here's his tweet. He's saying he believes Tesla's stock price is too high. Now, I'm a technician. I don't go by the news. I don't go by what Elon Musk says. I go purely by the chart. And I was looking at the chart and it told me otherwise. Let's take a look at a blog post on Tesla that I made from my website, tlivingstonblog.com, and you could see what I was thinking with Tesla, how I do not go by what Elon Musk says. I do not go by fundamentals. I go purely by the chart. So let's take a look at that post. Here we are at my website, tlivingstonblog.com, and you can see down here on May 30th, after Elon Musk made his tweet earlier in the month, I wrote a blog post about Tesla, how I felt it was forming a potential flag pattern and offered the opportunity for a strong run higher. So let's look at that blog post. So here I said, Tesla, extremely tight action the last 3 weeks after doubling off the lows. Potential for a very strong move higher. So here was my mindset here. I looked at this chart and I said, this stock has doubled and it has not given up any of its gains. So what does that tell me? That tells me even though it's doubled, people are refusing to sell it. They're saying, hey, I'm not taking profits. I'm going to hold this thing because it's headed higher. And I wrote here, Tesla has been on a tremendous run since late March 2020, more than doubling off the $350 range in less than 3 months. I really like its action over the last few weeks. Notice the very tight action on very low volume. It looks to be forming an O'Neill-style high tight flag. In How to Make Money in Stocks, a tight flag is defined as a stock doubling in price and then correcting 10 to 25% in 3 to 5 weeks. Although Tesla does not fit this definition perfectly, in the general sense, it's showing that extreme strength and a resistance to selling even after its large gain. Anything can happen here, and risk management is always the number one priority, but Tesla is definitely a stock worth watching for a strong move higher. So even though Elon Musk says he doesn't think this stock is headed higher, even though I don't know the fundamentals, even though I've never ridden in a Tesla and I don't know anything about the car, I just said to myself, look at this thing. This thing has doubled and it's not giving up its gain. So that's telling me people who own this stock, they say, hey, you know what? I'm not selling this because I think it's headed higher. That's very bullish when a stock is going up strongly and not giving up its gain. And also, I saw a chart pattern. This is a flag pattern. It went higher and then sideways. And then if it clears this 850, 900 area, it will head higher. So let's take a look at what Tesla did. As you can see, Tesla went on a very strong run in the summer of 2020. I tweeted about it in here. It broke out. We're going to talk about breakouts later on in the course. And then when it went on an extremely strong run higher here. So what made me bullish on Tesla at this point? Well, I don't know anything about Tesla's car. I've never been in one. I don't know much about Elon Musk. But what I do know is the stock doubled in price and then went sideways on very tight action. And then I saw it break out here on heavy volume. I took a position, and then you just ride this trend higher. So the chart told me what to do, not the fundamentals. This is the power of technical analysis. Here's Shopify in 2020. Notice it went from 350 in April all the way to 1050 in July. And here's what I want you to know: Shopify actually had negative earnings. Notice the earnings per share is negative. The company's actually losing money. The analysts say the one-year target is $810. It's already at $973 at this point, and it doesn't have a dividend. So fundamentalists would have missed out on this great opportunity because they'd say, well, it has negative earnings. Must be a terrible company. But notice, look, it doubled in price, more than doubled in price. So this is the power of charts. This is the power of technical analysis. You get to ride opportunities that a fundamentalist is going to miss. If you're worried about earnings per share and dividends, you're not going to be in a stock like this that goes on a very strong run. This is your double your money in a few months. That's the power of technical analysis. Summary. Charts give a visual representation of what is going on. It is often easier to ride trends than to try to evaluate a company's worth. A company may have negative earnings, but the stock may be rising in value. The key is to make money. The only way you make money is if the price rises. Thus, why not just focus on price? Because it's the only thing that pays.